chosen to join us today for FSAs, HRAs, and HSAs, more than alphabet soup. A couple of housekeeping things before we begin. We muted everyone when you joined the call today to make sure everyone has a good audio experience. We will have time for questions at the end of the presentation. So if you have a question you'd like to ask, please send it using the Q&A section on the right-hand side of the WebEx event screen. I will capture your questions and we'll try to answer as many as we can at the end of the presentation today. Attendees will receive an email with the link to the recording of the presentation along with handouts. This session has been approved for HRCI continuing education credits, and a certificate of completion along with the activity code for you to submit will also be emailed to participants. So a little bit about Pinnacle before we get started and why we're so passionate about the topic today. Pinnacle Financial Partners was founded in the year 2000 and has grown significantly to be one of the most respected financial institutions. Built upon the premise that financial services is not just a commodity, but a service where clients want to be treated fairly and treated with respect by someone who knows and understands their personal and business needs. Headquartered in Nashville, Tennessee, with physical locations in multiple states, we serve clients throughout the country with employees in just about all 50 states. Our health and benefits team administers the full suite of tax advantage accounts, including HSAs, FSAs, and HRAs that you're about to hear about. So a little bit about our presenter. I'm pleased to introduce Fern Emery. Fern is an integral part of the Pinnacle Health and Benefits team and has over 13 years of employee benefit experience. She is an industry expert in ERISA compliance and cafeteria plans. Fern is a sought-after speaker on the regional and national level, and we're so excited she's going to share her insights with us all today. Fern, I will turn it over to you.
Thank you so much, Mary. Just a few quick things to outline what you can expect to learn today from our webinar. This session will provide an overview of common consumer-directed health plans and tax-advantaged benefit accounts and the differences and similarities between each. We will discuss the IRS requirements for eligibility, regulatory requirements, and compliant plan designs. By the end of the webinar, you will be able to understand the differences between health FSAs, HRAs, and HSAs, identify when it's appropriate to add these plans to your overall benefit package, understand the tax advantages for each benefit, and recognize and comprehend the multiple regulatory requirements for each benefit. So let's get started. Just a quick disclaimer regarding today's webinar and the information we'll be discussing. The information we provide to you today may change tomorrow, especially given the urgency in which the IRS, Department of Labor, and Congress are passing legislation in the wake of COVID-19. Information provided is only for educational purposes. We are not providing legal, tax, financial, or medical advice. We always suggest that you speak with your benefit counsel to determine how these regulations and other regulations may impact your benefit plans. So today, the following key terms will be used intermittently throughout the webinar. I'm not going to list each one necessarily because I'll explain them further in, but obviously we're talking about FSAs, HRAs, and HSAs. But some other key terms we will also use quite often in the webinar are HDHP, for High Deductible Health Plan, COBRA, ERISA, SPDs, for Summary Plan Descriptions, grace periods, rollovers, and runout periods. Today we're going to tell a little story about a company called Oppa's Tennessee Shine and their 2021 benefit renewal. This company is an LLC, taxed as a partnership. There are two partners. The LLC was established in June of 2018. Things have been very interesting in the world of employee benefits front with this new company, especially with the pandemic. They've grown to 101 employees as of 1/1/2021, all of who are enrolled in one or more of Oppa's employer-sponsored benefit plans. Meet Oppa. He owns Oppa's Tennessee Shine. His goal for his company is to be the #1 bourbon distillery and distributor in all of Tennessee. He also wants to be the best place to work in Tennessee and have the best benefit package for his employees. He knows that engaged and happy employees make for engaged and happy clients. Opening and running a successful business is not a one-dog show. He's also known to make bad decisions and get in trouble sometimes. So he made sure that he had a good business partner who could help him find and hire the most experienced key players in the company. Winnie is Oppa's business partner and also a member of the LLC. Winnie is in charge of getting the right people on board to help with their employee benefit plan. Winnie and Oppa's first employee hire was Mr. Baggins. They hired him mostly on account of his mustache, but they soon found out that he also was well-versed in employee benefit regulations and finance. Winnie and Oppa also hired Duke to help build their benefit package with their insurance broker, as well as their other benefit partners. If their goal was to be the best place to work, then Duke has a very integral role in its success as both the head of HR and the employee engagement officer. Duke has a wealth of knowledge in employee benefits. He knows that he has a lot of balls to chase when it comes to balancing the responsibilities of a comprehensive employee benefit package. As such, he relies heavily on their insurance broker, their insurance carriers, and other benefit partners. Now, Oppa's Tennessee Shine just went through their first benefit renewal. But before we discuss what they adopted for their 2021 benefit package, I want to show you their initial proposed medical benefits for 2021. They had 2 health plans, a high deductible health plan and a PPO plan with a lower deductible and copays. They felt like having 2 different benefit options for their employees would help their employees feel supported. While they were going through their first renewal season, starting in September of 2020, their broker introduced them to some other ancillary benefits that might help increase and sustain employee engagement. They were told that these benefits coordinate with medical plans to offer tax advantages to both the employer and the employee. Now, hearing this made Oppa, Winnie, and Duke very excited to learn more about offering a comprehensive health and benefit package to their associates. Now, Mr. Baggins also agreed, but as a compliance person, his excitement is always a little more contained. As a finance guru, he perked up at the idea of tax savings. He also wondered what type of regulatory compliance might accompany these types of benefits. Now, their insurance broker wanted to share the differences between these tax-advantaged accounts, known as health FSAs, health reimbursement arrangements, known as HRAs, and health savings accounts, better known as HSAs. And understanding how they all worked with their medical benefits would allow them to choose which made the most sense for their employees. Now, one thing their broker did tell them ahead of time, with the types of medical benefits they were offering, they really wanted to focus on general purpose health FSA plans. Other types of FSA plans, such as limited purpose and dependent care FSA plans, were also mentioned but weren't a focus of the conversation. When discussing HRAs, their broker did not introduce them to QSERAs or ICRAs because they did not feel that they made sense for this company or their benefit goals. Oppa's Tennessee Shine wants to encourage enrollment in their own health plan, and ICRAs, known as Individual Coverage HRAs, offer assistance with individually obtained medical coverage through marketplace plans. A discussion on QSERAs, known as Qualified Small Employer HRAs, didn't make sense either, because these are only for qualified small employers, and Oppa's Tennessee Shine is a large employer. Instead, the focus was on traditional HRAs, which are integrated with the employer's major medical coverage, and allowable expenses are determined by the employer and the plan design. So what do all these acronyms mean, and what do they do? Well, health FSAs are employer-owned, and employer-established tax-advantaged medical savings account and self-funded health plans used to pay for certain health expenses. Pay close attention to the fact that this is employer-owned and employer-sponsored. While employees typically contribute the bulk of the benefit, the account is owned by the employer. Health reimbursement arrangements are also employer-owned, but they are not accounts. They are employer-sponsored, self-funded health plans that reimburse for certain qualified health expenses. Health savings accounts are employee-owned, tax-advantaged medical accounts used to pay for healthcare expenses. It's essentially a medical bank account opened by an employer on behalf of an employee. While an employer may offer HSA contributions through their Section 125 or pre-tax benefit plan, the account belongs to the employee just like the employee's bank account. In order to be eligible to participate in any of these plans, you must meet certain criteria. Furthermore, if you wish to participate in any of these plans, you cannot be self-employed, a sole proprietor, a partner in a partnership, or a greater than 2% owner in an S corporation. However, you could contribute post-tax to an HSA plan. To qualify for a health savings account, you must be enrolled in a qualified high-deductible health plan. This means that your minimum HDHP deductible for 2021 must be at least $1,400 for single coverage and $2,800 for family coverage. Additionally, you cannot have other disqualifying coverage. For example, if you were dually enrolled in Medicare and your employer's HDHP, Medicare is a disqualifying health plan. General purpose FSAs and HRAs that pay prior to the minimum deductibles are also disqualifying plans, even if it is your spouse who is enrolled in one. In order to be eligible for an FSA, you must be eligible to participate in your employer's major medical plan. Even if you decline medical coverage and are covered under a spouse's plan or a marketplace plan, you are still technically eligible to participate in a health FSA, but many employers choose to require employees to be enrolled in their major medical plan to ensure that they are compliant with certain Affordable Care Act rules. In order to be eligible for an HRA, you have to be enrolled in your employer's major medical plan or any group health plan. Just like the FSA, most employers do not allow employees who are not enrolled in their health plan to access the HRA, especially since HRAs are 100% funded by the employer. Now, Winnie and Oppa were super bummed to find out that certain people within a company aren't eligible to participate fully in one or more of these plans. Since Winnie and Oppa are members of the LLC taxed as a partnership, they can participate in the employer-sponsored HRA. They could participate post-tax in the health savings account if they chose to, since both are enrolled in the high-deductible health plan. Their individual tax advisors told them that they could take an above-the-line deduction on their taxes for their qualified health expenses, or they could contribute to an HSA post-tax. Knowing that they couldn't participate fully in these plans themselves didn't deter them from exploring more about how these plans might work for their employees. So we keep discussing, quote unquote, certain qualified expenses, but what does that mean? What are these expenses and who qualifies them? Well, qualified health expenses are outlined in IRS Publication 502, and they are referred to as 213D expenses. The IRS determines which expenses are considered qualified. Now, HSAs can reimburse 213D expenses, COBRA premiums, Medicare premiums as long as the HSA account holder is at least 65 years old, and they can also reimburse long-term care premiums. Health FSA can reimburse most 213D expenses, and we'll share some of the 213D expenses on the next slide. They cannot reimburse premiums. HRAs can reimburse 213D expenses, certain health plan premiums in the event that you're an employer who offers an ICHRA or a QSARA. Long-term care premiums are also eligible expenses. But the interesting part about HRAs is an employer has a lot of freedom to determine what type of expenses they want to allow. One plan might allow all 213D expenses. One might only reimburse deductible or coinsurance expenses. Another might only choose to reimburse prescription drugs. Employers have a ton of freedom to design the right HRA to integrate with their major medical plan. So here are just a few common 213D expenses: acupuncture, chiropractic care, dental care, prescriptions, vaccines, insulin, feminine hygiene products, and over-the-counter products as a result of the CARES Act, which was passed in 2020. I won't read the entire list to you because this is only a handful of the qualified expenses. And because Oppa asked, pet insurance is not a qualified 213D expense, nor can you use any of these accounts to pay for pet expenses. Now, Oppa's broker explained what these benefits are, but they needed to know why they should offer any of them. Well, first of all, we know that comprehensive benefit plans help employers maintain employee engagement and retention. However, there are some tax advantages to offering one or more of these benefits. If you contribute and allow employees to contribute to an HSA through a pre-tax Section 125 plan, you can save money on FICA and FUTA. Additionally, offering an HDHP typically provides for lower insurance premiums for both the employer and associate. An employer can offer an HSA to its employees to further cash in on the pre-tax savings. Health FSAs also offer pre-tax savings on FICA and FUTA, and employees' health claims expenses are tax-free. HRAs also offer tax benefits to employers. The expenses and claims are tax-free. Furthermore, an employer may offer these alongside a high-deductible health plan to quote-unquote buy down some of the premium costs. This allows them to balance plan risk. An example of this is an employer who has a high-deductible health plan to save on premiums, but they might design the HRA to reimburse employees after they only meet a certain portion of the deductible. And depending on claims risk and the health of the overall population, an employer may find that they've saved a ton of money and still provided a more competitive health plan coupled with the HRA than if they had only offered a standalone medical plan. Now, Oppa and Winnie decided from the employer-owner perspective, saving money on taxes was a no-brainer. But what about their employees? What were the benefits to them? Well, HSAs allow employees to save for long-term or immediate health expenses. They may save for retirement or invest their funds. They save on FICA and FUTA, and they earn interest on their accounts. Employees own the account, so they can take the HSA with them even if they leave their place of employment. FSAs allow employees to save for medical expenses, and they save on FICA and FUTA. Additionally, the entire FSA balance is made available to enrolled employees on day one. So unlike the HSA, where you have to have a balance in the account to use it, an employee could have a claim on the first day of the plan year and use their FSA account. HRAs are kind of like free money to employees. Of course, they are employer-owned, and employees don't contribute, but the employees aren't taxed on their health claims. And they receive reimbursement from the HRA as long as the expense was qualified by the IRS and qualified under the plan design rules. So who can contribute? What were the rules surrounding contributions? Mr. Baggins was curious. Well, anyone can contribute to an HSA. They are employee-owned accounts, so annually, an employee could contribute themselves, receive employer contributions. Even family members and non-family members can gift contributions to an HSA. With a health FSA, only employees and employers can contribute, and employer contributions are limited in order for the benefit to be quote-unquote accepted under the Affordable Care Act. And we'll discuss what that means on the next slide. Employers are the only party who can contribute to an HRA. Now, if a covered employee terminates and elects COBRA, that's the only reason an employee could contribute to the plan. Otherwise, an HRA is 100% funded with employer money. What are the contribution limits? As far as limitations for HSAs and FSAs, these are indexed annually. With the HSA, an account holder has until tax day in the following tax year to fully contribute for a prior year. For 2021, the HSA contribution limit is $3,600 for single coverage and $7,200 for family. And once you hit the age of 65, you are allowed to make a catch-up contribution of $1,000 annually, which is in addition to the IRS maximums. The health FSA employee contribution limits for 2021 are $2,750. Employers may contribute either $500 or a dollar-for-dollar match. So an example of a dollar-for-dollar match is someone elects $600 and the employer contributes $600. Or an employee elects $2,750 and the employer contributes $2,750. The importance of this employer limit, coupled with the employee being eligible for the employer's major medical plan, is this makes the FSA accepted. FSAs and HRAs are health plans. However, on their own, they do not meet the minimum requirement under the Affordable Care Act to be a MEC plan or a minimum essential coverage plan. They don't offer essential coverage. They have annual maximums, which are not allowed for health plans to be considered MEC plans under the Affordable Care Act. Therefore, when reviewing the limitations and the rules to both plans, the regulators enacted certain requirements to allow these benefits in conjunction with other coverage. If an FSA is not accepted, it is subject to certain PHSA mandates, which include offering essential coverage and no limitations, and FSAs on their own cannot do that. Not meeting these mandates equates to hefty IRS penalties. HRA contribution limits are flexible, meaning they are based solely on the plan design. So what happens if an employee doesn't use all their contributions? Well, with an HSA, if an employee has a balance in their HSA after the tax year end, they just roll it over. It's their account. With FSAs, if you have money left over at the end of the plan year, generally it's forfeit, and that money stays with the plan. It's use it or lose it. Employees do not get to cash out their contributions. Plans will design claims runouts to allow employees to file claims against benefits they incurred during the plan year, but they can also design rollover and carryover options where limited unused funds are rolled into the next 12-month plan year, which is indexed at $550 for 2021, or they can offer a grace period, which gives them additional time in the first 75 days of the next plan year to use all their funds. Now, some of these plan design options changed a lot, with COVID relief legislation passed in 2020, and we'll discuss that in a few slides. HRA funds may roll over or they may be forfeited after a run-out period. It depends on the employer plan design. You're going to hear that a lot about HRAs. It depends on the employer plan design. Some HRAs are designed to roll over in perpetuity until an employee retires, and then the retiree has the entire balance to spend down. Some HRAs don't allow rollovers at all, and some allow a limited rollover, much like an FSA. So what happens to these accounts in the event that an employee terminates? Well, with an HSA, the employee owns the account, so the funds go with the employee. Aside from the run-out period, if an employer is subject to COBRA, COBRA applies to FSAs and HRAs. For FSAs, COBRA must be offered on any unused contributions as long as the employee has not overspent their account. COBRA is only maintained through the end of the existing plan year in which they terminate, so not the full 18 months. And COBRA must be offered on HRAs. Now, many employees don't elect COBRA on these benefits simply because they're not pre-tax any longer. Furthermore, they may be required, they're going to be probably required to pay the COBRA fees on top of their monthly contribution. But just because someone doesn't elect it doesn't mean it doesn't have to be offered. Additionally, every beneficiary must receive a COBRA notice, and an employee and their entire family could elect COBRA on these benefits. So there was a lot for Oppa and his crew to chew on. So he chewed and he chewed, because that's what he likes to do. Which of these benefits help their company reach their goals? Well, they could couple one or more of these benefits together with their major medical coverage. They and their employees could save on taxes. Oppa could contribute to their benefits, and employees would like that. And they would like to get an option to choose one or more of these benefits, which would help them enrich their lives. Oppa had been made aware that COVID caused a lot of upheaval in the world of employee benefits, and especially with these pre-tax plans. So he needed to understand more about this as well. A lot of his employees have suffered greatly in the last year as a result of the pandemic. The Consolidated Appropriations Act 2021 was passed by Congress and signed into law by President Trump on the 27th of December. Earlier in 2020, the CARES Act and some additional IRS notices gave a lot of relief on how funds could be used for these pre-tax plans. The CAA update includes multiple relief provisions, including allowing an employer to carry over all unused FSA funds on health FSAs and limited purpose FSAs, which would be rolled into the following year. And this means that there is no $550 maximum. It's all unused available funds. And this is starting with unused funds for plan years ending in 2020, being rolled into 2021, and then from 2021 into 2022. And again, normally these unlimited rollovers are not allowed. The Act also allows plans to extend their grace periods from 75 days to 12 months. This is for plan years ending in 2020 and 2021. The important thing to keep in mind about all this is FSA rollovers and grace periods impact HSA eligibility. So if you offer an FSA and an HSA plan, you have to look at the impact on individual associates before choosing to implement this optional relief. The Act also allows employees to drop, change, elect coverage prospectively outside of mid-year election events. An active employee who drops coverage can still access their contributions that they made while they were actively enrolled, and they could continue to incur claims against it. Again, all of this is optional, and this is up to the employer whether or not they wish to elect any of these provisions here, either separately or collective. And while we're not discussing dependent care accounts today, I do want to touch on the updates to what type of this type of tax advantage plan. The Act increases the age for eligible dependents from 12 to 13 in 2020. They also allow the rollover of unused funds, which has never been allowed, plus the extension of any dependent care account grace period that can be extended from the 75 days to 12 months. Now here's a list of the Section 125 mid-year events that I mentioned on the prior slide. Almost all cafeteria plans allow the election changes listed here, some of which are not optional, but many are. The mid-year election event change has to be consistent with the event that occurred. For example, if a dependent child ages out of the plan, the event created by the child turning 27 means the employee can drop coverage on their dependent. It does not mean that the employee, spouse, or any other dependents on the plan can then cancel or change their coverage. Section 125 calls these consistency rules, and they've outlined multiple of these. With the COVID relief options that became available in 2020 and 2021, should a plan adopt this relief with the mid-year election changes, an employee can pretty much simply change their mind and make changes to their coverage, which would be otherwise irrevocable outside of these events listed here. Now, an employer does get to design how this works, and if they even want to offer it, they can pick and choose which plans to apply the relief to and how often they allow their employees to make changes. So now that Oppa got the rundown on all of his options in COVID relief, it was time to discuss their major medical plan renewal. They were going to offer a qualified HDHP option and a PPO plan option. They definitely wanted to offer the HSA to employees who elect the HDHP. They wanted to offer the FSA option to the PPO employees, but they also decided to allow the HDHP enrollees who declined HSA coverage for whatever reason to be able to elect the FSA. They wanted the HRA benefit to reimburse $1,000 for all eligible 213D expenses. But this one could be potentially tricky to align with HSA eligibility, so it had to be done carefully. the employee was going to have to meet their HDHP statutory deductible before the HRA paid in order for the HRA not to disqualify their HSA eligibility. They also had to determine with the FSA eligible employees if the FSA would pay first or second to the HRA. Now, if the FSA paid first, an employee had an eligible expense, they would have to file it against their FSA plan first, and the HRA would only pay after all the FSA funds were depleted. Now that they know what type of tax advantage plans they want to offer with their medical plans, they needed to figure out the specific FSA and HRA provisions. Now, since FSAs and HRAs are medical plans, there's a lot that goes into making sure that they're compliant with certain rules, like offering claims deadlines. How long was their claims deadline going to be after the plan year ended? Well, this deadline is called a runout. They decided that they would allow 90 days. That means that any claims incurred in the plan year would have to be filed 90 days after the plan year ended, or the claim would be denied. They also had to determine if they wanted to offer a grace period or a rollover. They decided yes to the rollover, but only for the FSA. They did not want to offer rollovers on their HRA. They did not elect to offer a grace period on the FSA, since you can't have a grace period and a rollover at the same time. And finally, they did decide to allow all of the COVID mid-year election changes, but this was the only COVID provision they adopted. But this fueled further questions. If rollovers disqualify HSA eligibility for the next year, how could they navigate that issue? The broker told them something about a limited purpose FSA, which they could offer in conjunction with the HSA to pay for certain dental and vision expenses. This would allow them to maintain eligibility in their HSA while offering the rollover of unused funds. Now, the idea of runout versus rollover versus grace periods got a little confusing for Oppa, so he asked for a more clear explanation. A runout is a claims deadline. Simple. It's how long after your plan year ends to file a claim. Every plan has a runout. A good way to remember what a runout is with this little thing. Hurry up and submit your claim before you run out of time. Fun with puns. Rollovers are unused funds that roll over and add to the balance of the new plan year. You have that money available to you all plan year long. Generally, an FSA rollover is limited to $550, or whatever the IRS indexes it as for that year. Grace periods are extra time to access all of your prior year unused funds, but you only have a maximum of 75 days to use it. Then the funds are forfeit. Ultimately, here are the benefits adopted by Oppa's Tennessee Shine for 2021. They'd offer the HSA for HDHP enrollees, the FSA for PPO and HDHP enrollees who declined HSA coverage. There would be a $550 carryover for both the general purpose and limited purpose FSA. The HRA would be available for all employees who are eligible, that's important, for their group health plan. HSA enrollees would only be able to access these funds after meeting the HSA statutory deductibles. FSA enrollees would have to use their FSA funds first. They decided that they would go back and review the additional COVID relief legislation options later in the year to see if they needed to adopt any. Now that benefit decisions were made, here comes Duke. Duke is in charge of ensuring employee communication regarding their benefit plan is accurate and timely. Open enrollment materials, summary plan descriptions, enrollment forms, all the questions, they all fall on Duke's shoulders. Duke is a hero. This is just a few examples of the types of communications that Duke is responsible for ensuring are distributed to associates. The FSA and Section 125 Plan SPD, as well as the HRA SPD, a consumer and info guide so employees know about their plan offerings and how to access their funds and file claims, who to contact. There may also be open enrollment benefit booklets and other handouts and employee notices required as well. And again, Duke's going to get a lot of questions from his fellow associates. We sure hope that Duke is ready. Sparky is an employee. Sparky has excessive thirst, so he drinks out of the toilet at work. He wants to see a doctor for this problem, but he wants to know if his FSA account or his HRA will help. Well, when he went to the doctor, he paid a $30 copay, and he was told drink Pedialyte. Well, doctor office visits and Pedialyte are FSA eligible expenses. Sparky is very happy. Duke is also happy because he would like for Sparky to stop drinking out of the work toilet. Duke has received many complaints about this behavior. Georgia just adopted a kitten named Cosmo. Baby items is super expensive. Can Georgia save on any baby items for Cosmo? Yes, multiple baby items are 213D eligible expenses, and they can be paid for with the Health FSA and the HRA, including thermometers, diaper rash ointments, even booger wipes, are eligible expenses. Pedialyte, which is normally for children, as we discussed on the last slide, is also an eligible expense in the event that sweet Cosmo ever needs it. Louie needs paw surgery. Louie has an HSA and is on the HDHP. Will his HRA help with any of this expense? Well, it depends. His HRA will reimburse after his HSA statutory deductible is met. The amount of the HRA will reimburse depending upon the overall cost of the procedure, as well as whether or not Louie has met any of his HSA deductible. To date, he has not met any part of his health plan deductible, and his surgery is $3,000. He will need to pay out of pocket for the first $1,400 of expenses. Then the HRA will reimburse the next $1,000, and that will leave an additional $600 that Louie will be responsible for. He will have to pay a total of $2,000 for his surgery. Now, whether Louie chooses to use his HSA funds or not is up to him. He can choose to use his HSA, he can keep his HSA funds in savings or in investments, or he can use his normal bank account funds to pay for it. Totally up to him. Copper and Riggs, the bourbon taste testers, have colds, and now they can't do their jobs effectively. They've lost their sense of taste and smell. Well, since loss of taste and smell is a symptom of normal colds as well as COVID, everybody is a little on edge about these two. Do they have a cold or is it COVID? Well, Copper has an HSA, Riggs has an FSA, and here's how the whole scenario goes down. Both of their physicians required a COVID test. Under the CARES Act, the test and the doctor visit is covered at 100%. The fact that this service was paid at 100% before Copper met his HSA deductible doesn't matter, because the CARES Act stated that it would not disqualify him from his HSA. Luckily, they do not have COVID. It's just an everyday cold, and over-the-counter medicines are eligible. Now, before Copper's HRA will reimburse anything like cold meds, he has to meet his HSA deductible, and Riggs is going to have to use his FSA funds before his HRA will reimburse any of the expenses. Otter has separation anxiety. She always sits really closely to people. She needs to see a therapist. Otter is covered under her spouse's group health plan. While she is eligible for Oppa's Tennessee Shine's major medical plan, she declined medical coverage. She is covered under Oppa's HRA plan. She's also covered under Oppa's dental, vision, and limited purpose FSA plans. Now, how is it again that Otter was able to enroll in the HRA without being covered under the health plan? Well, the HRA rules allow an employer to provide HRA coverage as long as an employee is eligible for their group health plan and covered under other group medical coverage, even if it is sponsored by another employer. So Otter can use her HRA sponsored by Oppa in order to pay for her mental health services. Now, her limited purpose FSA plan doesn't apply to mental health services. It only applies to dental and vision. So there's not going to be any reimbursement from that account. Now, here's a really important thing to note. Otter's spouse in the plan that Otter is covered under is a traditional PPO plan with her spouse's employer. If Otter's spouse had an HDHP with an HSA, This first dollar HRA coverage sponsored by Oppa would disqualify their family from having an HSA. However, since Otter's spouse's coverage is a PPO plan, the HRA does not pose any issues to their overall tax plan. Winnie, the LLC owner, is OSHA certified, but sometimes she has accidents. She had to wear the cone of shame. Winnie cannot participate in the HRA, or so she was told, because she's an owner, but she just wanted to make sure and confirm. The answer is still no. Owners and members of LLCs, taxes, partnerships are ineligible. She did decide to contribute post-tax to her HSA, and she decided to use some of those funds to pay for her doctor expenses. Another question Duke will get a lot is, why do I have to provide a receipt for FSA or an HRA expense if it's my money? Shiloh, Nash, and London all came to Duke on the very same day to ask this very same question. Well, the short answer is because the IRS says so. Like any tax deductions you might claim in general, the IRS would want validation that your deduction is qualified, and this is no different. Furthermore, HRAs and FSAs are group health plans, and they have to be processed and validated by an independent third party in order for that expense to be considered eligible. With HSAs, you do have to keep your receipts, but you would only need to present them in the event of an IRS audit. HSA distributions do not need to be substantiated to the extent that HRA and FSA claims do. Now, because Duke wants to avoid any confusion about what's required, Duke asked their flexible benefit administrator if they had any material on substantiation requirements. And they did have materials that they could share because they, too, get asked this question all the time. They provided it to Duke to share with his associates, and it included information on substantiation and what a proper receipt looks like. In order for a receipt to be valid, it must include a date of service, the name of the patient, provider information, services rendered and/or items purchased, as well as the cost of service or patient responsibility. The information on the receipt must match the claim form or the debit card swipe. Carrier explanation of benefits, or EOBs, are excellent receipts, and you can download these from your carrier's website. They will mail them to you, but you're going to get them faster if you log on and fetch it yourself. You may also get a statement of account from your provider. In the event you swipe your debit card, you have a reasonable amount of time to submit the receipt to the third-party administrator. Now, reasonable amount of time isn't clearly defined by the IRS. It's up to the administrator, but I think a good round number is typically 60 days. If you don't provide a receipt after that amount of time, an administrator may temporarily suspend your debit card access, which can be unsuspended with a valid receipt. If by the end of the plan year you haven't provided a receipt, you may be asked to pay the plan back. If that's not done, an employer may include that unsubstantiated claim amount as taxable income on an employee's W-2. Now, the IRS has outlined all the steps required to properly substantiate a claim, as well as remediation steps. This is for both HRAs and FSAs. Now, remember, if claims are tax-free to the employee and the employer, they have to be validated just like any other health claim. If a plan doesn't properly substantiate or take these steps, they may be putting themselves in risky danger of disqualifying their pre-tax plans. Now, Duke and Mr. Baggins sometimes like to tackle things together. This includes communication and compliance, because sometimes communications are required by law. This includes maintaining compliance with ERISA, COBRA, HIPAA, multiple IRS codes, non-discrimination testing requirements, PCORI, certain welfare notices, etc. A few of these requirements that we're discussing on the next slides are specific to Oppa's plans because there are multiple compliance requirements, some which are very nuanced and dependent upon what type of company you are. These recommendations were discussed with their benefit counsel to ensure that they were following the rules as it applied to them as a company and plan sponsor. Because Oppa's Tennessee Shine is subject to ERISA, they have to comply with ERISA. Employers whose welfare plans are subject to ERISA include anyone who is not a municipality, a church, or a Native American Indian sponsored plan. ERISA is the Employee Retirement Income Security Act of 1974. Title I of ERISA outlines employee rights and employer responsibilities for employers who are subject to it. HSAs in general are not subject to ERISA, even if an employer is subject to it. FSAs and HRAs are ERISA welfare plans, which means an employer who is subject to ERISA must also comply with ERISA's reporting and disclosure requirements. They must also adhere to the COBRA rules if an employer is subject to COBRA. The ERISA requirements include having a written legal plan document outlining the plan, its fiduciaries and terms, a summary of the plan, which is called an SPD, which must be provided to employees and beneficiaries within certain timelines, and Duke already distributed it to his associates and beneficiaries. Certain employers are required to file what's called a Form 5500 7 months after the end of the plan year. A 5500 is an annual report provided to the DOL, which includes certain plan information such as premium, funding, employee counts, employer information, insurance information. And the reason that you may have to file a 5500 is if you have 100 or more enrolled employees on the first day of the plan year. Oppa has 101 employees enrolled in their HRA plan as of 1/1/2021. Other reasons a small employer might have to file a 5500 is if they are a multiple employer welfare arrangement or a MIWA who is subject to M1 filing requirements, or they are a small employer who holds their plan assets in a trust. Oppa will need to file a 5500 on his HRA plan due July 31st, 2022. If he does not file by that date or file an extension, the filing will be delinquent and penalties will accrue. As far as disclosures for Section 125 plans, IRS Section 125 only requires disclosures for certain pre-tax plans and not all of them. So if you're an employer who only sponsors a premium-only conversion plan, which includes your premium-only benefits and your HSA perhaps, only a plan document is needed. However, most employers who offer an HSA with a premium-only tax conversion plan will distribute an SPD so that employees understand their rights. That is the best practice. You should do it, even if you don't have to. If you also sponsor a health FSA or a limited purpose FSA, you do have to provide these terms in the form of an SPD. Dependent care FSA plans also have certain disclosure requirements. Now, most employers will try to include all of their pre-tax benefits into one document so that they can comply with all the disclosure rules in one fell swoop. As far as HRAs and Code Section 125, the type of HRAs we're discussing today are not required to be noted in a pre-tax Section 125 plan since they are 100% employer-sponsored and no contributions are made by employees. PCORI fees came about as a result of the healthcare reform in October of 2014. PCORI stands for the Patient-Centered Outcomes Research Institute, which was meant to support clinical effectiveness research. These fees were supposed to stop being assessed at the end of October of 2019, but the fee assessment was extended. Health plans, especially FSAs and HRAs, are self-funded health plans. They're supposed to file PCORI fees. HSAs are bank accounts and they're not subject to it. Now, the whole crux, again, about an FSA being an accepted benefit is that they don't have to file PCORI fees. It's generally rare that an FSA would be subject to PCORI. So it's, again, a whole other reason to keep FSA as an accepted benefit. They are not subject to it currently, and HRAs are subject to PCORI fee filings. Currently, I believe the PCORI fee is around $2.54 per average life per year. They're due July 31st each year. They're filed on IRS Form 720, which is the quarterly federal tax return form. Each one of these plans is subject to non-discrimination testing requirements under different and certain IRS codes. Testing is supposed to be done annually to ensure that pre-tax plans don't favor highly compensated employees in operation or in usage or contribution methods. HSAs are subject to 125 testing. Health FSAs are subject to 105H testing for self-funded health plans as well as Section 125. And HRAs are subject to 105H testing. However, the 105H rules are not totally clear on how to apply them to all of the different types of HRA plan designs that are available. As a result, many HRA plans are just simply not tested because it can't be done. Non-discrimination testing is nuanced. Some people call it an art form. And many administrators and attorneys don't even agree on the correct approaches for testing or remediation. Furthermore, the IRS isn't actively auditing plans for testing results. However, it's always a good idea to be compliant in the event the IRS does begin to initiate audits. And many times, testing results are requested during mergers and acquisitions, along with other plan materials, to determine the overall risk of the transaction. So it's always a good idea to have it. Well, Oppa and his team certainly have to keep their paws on the pulse with all the regulatory requirements that welfare benefit plans are subject to. But what about future legislation or regulatory updates? Well, he definitely has his ear to the ground, as do his benefit administrators, but what he would really love is to get in good with the President of the United States dogs, Major and Champ, so he can get a heads up on what's next. But we've gone ahead and done some of that for him. To date, obviously, COVID legislation is a huge button. We know right now that there are discussions about advancements in HSA eligibility, such as having HSAs compatible with Medicare coverage, as well as increasing balances. We know Ted Cruz submitted a bill to eliminate the requirement that HSAs be tied to HDHPs. Further discussion around COVID COBRA subsidies. There are chats about subsidizing 85% of COBRA insurance premiums for people who've had a reduction in hours or laid off as a result of COVID. A review and possible extension of the COVID outbreak period, which started March 1st of last year, and we're inching up upon that deadline. I imagine that they will extend that, but most of us have been operating under that for a long time now, and it impacted COBRA provisions heavily. And one big one here is there was a bill introduced that PPE, like hand sanitizer and face masks, would be allowable 213D qualified expenses, which they are not currently, and if approved, it would likely only apply during COVID and not ongoing allowable expense. So there's definitely a lot happening in Washington right now, and we are paying attention. So that concludes our webinar. Our next webinar will be April 21st at 1 p.m. Central Standard Time. The topic will be centered around health and wealth strategies, using HSAs and other tools to complete your financial plan. This will include discussions around 401ks, HSAs, and strengthening your overall portfolios. This will also be for HRCI credit, and we hope you can attend.